Alright, welcome to another run through of the top 5 charts of the week. So this is just a quick walkthrough of the free email that goes out roughly middle of the week, and we're going to talk through 5 very interesting charts. So the first one here is the long-term earnings growth outlook for the S&P 500. So this is the consensus from the Thomson Reuters data stream IBES consensus or aggregates, and so this is they poll a series of stock analysts and compile it all up to present a view for both individual stocks but also for the index. Pretty much the gold standard for consensus earnings estimates. Now this chart here is quite an interesting one actually. So again, it's the long-term average earnings growth estimate, and it's worth walking through some of the history of this chart. So the first phase, from sort of the mid 80s through to the mid 90s, it was kind of like, for the analysts, just write down 11% and say it's roughly about that, or a little bit higher, a little bit lower. But then it just took off and reached a fever pitch during the dot-com bubble peak. All this hype about the new economy, and much of it at that stage was hype. I mean, in the long run, certainly for a couple of standout companies, the new economy did come along. But then that came back crashing back down to earth, and it went back down to that sort of just say 11% again. And of course we had the big Great Recession, and that knocked pessimism, that extreme pessimism around that episode there brought the long-term earnings growth outlook crashing down to the lowest on record, which was only matched again more recently during the sort of secular stagnation scare, when we had this commodity crunch, emerging market crunch around here, global trade recession as well. And then we had this big turnaround with the reflation, and the tax cuts ended up extending that further. So now at this point it's kind of a bit of a riddle as to where it goes next. Looking at the history of it, it tends to be almost a contrarian sentiment indicator. At the height of the dot-com boom, when it was so euphoric, it was basically a good contrarian sell signal at that point. And in the wake of the global financial crisis, when it got to such morose and pessimistic levels, that was actually a good buying signal, as it turned out in hindsight. So it could cause one to wonder whether it's now acting as a contrarian selling signal once again, because I guess that's the other question that people might have is, when it's this strong, where do you go from here? So I'll leave you with that, and also leave you with part of that quote from Irving Fisher, who suggested that stocks had reached a permanently high plateau just, I think it was either days or weeks before the top of the market in 1929. Anyway, number 2, US dollar versus the world. So we've got 4 in 1 here, and really it's all about the US dollar. First one here, US dollar index. Second one, EMFX. It's an equal weighted index that I have compiled based on 25 emerging market currencies. Asian FX down the bottom left. Again, it's an equal weighted index based on 10 different Asian currencies. And probably the most important Asian currency, and maybe even the most important exchange rate, is the USDCNY, which is the Chinese yuan or renminbi. And you can see there straight off the bat there's been some pretty interesting moves so far this year, and probably also in the last couple of weeks. US dollars strengthened, and I was talking about back then when it was at the low point that there was extreme shorts at that time, or that the longs had completely unwound and gotten to short. there's bullish divergence back then, and considerable yield support. At the same time, in the background, you had the Fed doing quantitative tightening. So it was you're never really certain in markets, but it was one of those situations where it's pretty high conviction bullish. And at this point, I think that we can still see a bit more overshoot to the upside. It's not overvalued yet on a number of metrics, and still substantial yield support. Fed's pushing on with rate hikes and quantitative tightening, and will probably just continue to do so, versus other central banks kind of, they're going to find it probably difficult to exit. So, with a situation or a scenario of higher US dollar, that's going to add further pressure on emerging market currencies, Asian currencies, USDCNY. I've talked at length about what's going on with USDCNY, so I won't labour the point here, but I will note that, if we do move past that 7.0 mark, that's kind of a line in the sand, and that's probably going to drive a bit of flow-on effects if we do see that. I think it's probably going to need to see a little bit of consolidation at the current levels, and certainly the PBOC commentary has been that they want to kind of keep it at equilibrium for now, so we'll see how that goes. But for now, I think it's reasonable to expect a little bit more US dollar strength, and if that kicks off a further wave of selling across these other ones, then that could kick off a bit of a negative cycle or a bit of a feedback loop. So one to be wary of. Now, these charts actually came from the Global Cross-Asset Market Monitor. That's a report that goes out to clients, covers all of the world's major markets. A few interesting proprietary indicators in there as well. Number 3, EM versus DM equities, a long cycle set to repeat. So this one shows the long-term view of relative performance between the MSCI emerging and developed markets, and it's showing those two indexes in USD terms. And you can see there that it underwent this sort of double bottom process in around the turn of the millennia, and there was quite a few things going on in the background there, which are actually quite similar to what's going on now. So the big macro puzzle pieces that fell into place back then throughout this sort of multi-year bottoming process and relative performance was the valuation aspect, so both absolute and relative value. Both had gone to very cheap and compelling levels. Another one was just putting a bit of clean out of the excesses through the system. Once you sort of put the economies through that sort of pain, it forces a bit of restructuring, a bit of structural change, and also just working through of the US dollar bull market, which basically the bull market ended towards the end of that period there, and again we're talking about possible further strength in the US dollar that could extend the bottoming process here for a little bit yet. So and also just the fact that economic recovery would take a little bit of time to work through as well. So it's a very interesting chart there, and certainly very interesting for those with a bit of a longer term time frame, and quite related to number 4 here, which is global equity valuations. And you can see there in the red line, that's emerging market equities, the P10 valuation metric, which is price versus 10-year average earnings. And you can see there that EM trading at a decent discount versus DMX US, and substantial discount versus US equities. Longer term valuations tend to speak for themselves, and they'll speak louder at extremes. So back in 2009, that was like a once in a Well, you probably can say once in a decade buying opportunity. Again, 2016, early 2016 there, and as I noted, around the turn of the millennia there, when you had um, quite a substantial drop in absolute, but also relative to what was going on in the other markets there. So definitely one for those active asset allocators to be thinking about. But short term could be a little bit more water to go under the bridge, especially if this currency scenario continues to play out. And last one, coffee is becoming a crowded short. So you look here, we've got the speculative futures positioning indicator, and see that traders are very short on coffee at the moment, and kind of makes sense. It's been in a bit of a downtrend there, and it's coming up to a key level. If it breaks that level, then it's probably just going to keep on going. But I'll read this out just because it's kind of it might be a bit too much, but it might be a bit funny as well. Coffee prices have been steadily grinding down, but as coffee plunges, one can't help but wonder if it might start perking up again. Coffee prices are currently percolating around the major support level of the past decade, and if they manage to hold its support, coffee might just have a shot, or even a double shot. The risk is prices spill over and pour down to new lows. So I'll leave it at that. Now, if you wanted to receive this email in your inbox, just click on the subscribe link, which I'll put in the description of the video. Otherwise, just go to topdowncharts.com and you'll find the subscribe button there. Hope you enjoyed this.